The CFO of Star Health and Allied Insurance is with us now. Hi, Mr. Kambli. It's a good set of numbers this quarter. Combined ratio, PAT, and ROE have all improved meaningfully year on year, with the loss ratio improving for the fourth consecutive quarter. Now, could you walk us through what has led to this consistent improvement?
We started this journey 18 months back when we said that, we want to grow profitably. For the quarter, our growth is 23% when it comes to retail business. As you correctly said, it's a fourth consecutive quarter of improvement in the loss ratio. All this started with our prudent underwriting guidelines, risk-based pricing. We have been taking pricing increase consistently over the period. Our focus on profitable business, avoiding certain portability markets, certain geographies which are not profit-making, or rather they are loss-making. Our focus on fraud, waste, and abuse to control the losses. All this has led to a consistent improvement. One more factor which has also helped is the home healthcare and telemedicine implementation that we have done. We provide medical services to the customers at the care of their home, or provide a second opinion, which has also helped us in controlling on our loss ratio. So we believe this is more structural in nature. There is no one-off, and we believe the improvement should be consistent over a period of time.
All right. Now, of the 67.5 to 68% retail loss ratio, how much is structural improvement, sourcing, portfolio mix versus one-off or seasonal tailwinds, lower teleconsultation cost, or favorable claims timing?
Loss ratios on a quarterly basis are seasonal in nature. Typically Q2 and Q3, the loss ratios are higher because of the impact of fever and infectious diseases during monsoon and post-monsoon. Q1 typically is a quarter where we have a higher impact of surgical claims, and we have seen that playing out during the quarter as well. As I mentioned, the improvement is coming largely because of our pricing actions, our strict underwriting guidelines, because of the focus on fraud, waste, and abuse, and that is more structural in nature. We believe there is no one-off, and the improvement should happen consistently over a period of time as well.
Right. So tell us a bit more about what specifically changed between the high single digit and the mid single digit guidance in the demand side.
No, I think there is some mistake. We have not spoken about single digit growth guidance. We have been growing at 19% on an overall basis. We have maintained that we should continue to grow around anywhere between 16 to 18% in line with the growth in market. And on a long-term basis, we should be able to maintain our market share as well. But we believe our growth should come with profits, and we just don't want to grow for the sake of growth. But we believe 16 to 18% growth is something which we'll be in a position to achieve consistently over a period of time.
How should we think about loss ratio trajectory over FY27 as the long-term policy mix, which is almost 40% of fresh premium, continues to build from here?
So, we have mentioned in the past, we don't want to give any yearly guidance on the loss ratios. We believe combined ratio is the right measure to improve the operating profitability of an insurance company. We believe around 97 to 97.5% on an annual basis is the combined ratio zone which we want to operate in, which will result into a mid-teens to high teens ROE, and that's what we're working at. In FY24, we had given a guidance that we'll achieve that by FY28, and we are well on course to achieve that number with the actions that we're taking.
And Nilesh, the combined ratio has improved to 97% from 98.7%. Now, what combined ratio level do you consider steady over the next 2 to 3 years? And how does further improvement split between loss ratio and expense ratio?
As I said again, we don't predict any quarterly combined ratios. On an annual basis, as I said earlier, we should continue to improve. Last year, we were sub 100 on an annual basis. We should continue to improve for the year as well and going forward. The objective is to maintain consistency when it comes to the operating results, and that is something which we'll strive for. The quarterly loss ratios is a function of various other things. The macro factors, the rainfall, and all that things. Very difficult to predict quarterly loss ratios.
How are you balancing price hikes against the risk of adverse selection, healthier customer churning out? Do you have visibility into persistency by cohort post price hike?
Yeah, absolutely. I think persistency is one important factor for the entire business, which also shows the customer satisfaction, which shows our strength of the agency business. In terms of premium, our persistency is 103%. In terms of volume, also it is high 80s, in terms of volume, which is around 87, 88%. So we believe we are one of the best when it comes to persistency of the renewal portfolio. So in spite of taking price increases, we are able to communicate it well with our customers, make them understand that this is required for the long-term sustainability of this health insurance business. And we are getting good responses, and we don't see any reduction in the persistency of the portfolio. For the new customers, we are able to go about giving them some discounts, making it attractive for the agents as well. And that is how we are building the new portfolio as well as maintaining our persistency or renewal portfolio.
Right, and finally, of course, investment income has risen, but annualized yield has fallen sharply. Is this a duration or asset mix shift, or is this simply a denominator effect that you're seeing from a larger book?
So for the quarter, if we see along with the mark-to-market gains, in fact, the investment is very, very good. It upwards of 10%. But what we see is, the portfolio construct that we have. We have a certain 80% of our portfolio is fixed portfolio where we see yields around 7.4, 7.5%. On the equity portfolio, we assume that this will at least give us 10 to 11% return on a long-term basis. And that is where we talk about normalized profit with the investment yield of 8% on a blended basis. And that is how we want to project our financials as well. There can be some short-term volatility, but we believe that's part of the game once we have implemented Ind AS. But over a 3 to 5 year horizon, we should consistently hit a 8% investment yield with the portfolio construct that we have.
Thank you so much for joining in and answering all the questions for us today. Thanks.